So you need to ask yourself, how much is the retention ratio per year? Because the dividend payout ratios are given for each year. So there is a retention ratio. Dividends are paid out of profits. So if you pay 20%, means the 80% remaining is retained. The sixth assumption, retained earnings are added to equity in the next year. That is simply, treatment of the retained earnings. The examiner is telling us there. Number 7, we are told total assets are 80% of current year sales in all years. So the assets that we are going to use in our model statements, we are being told is 80% of every year's sales. Number 8 assumption, in year 1, we are told debt is 40 million and shareholders' equity is also 40 million. Debt is equal to total assets minus shareholders' equity. The examiner has been very kind to also add that information, but even if they don't add it, as a student in this level, you are expected to already have it. We are told shareholders' equity will equal previous year's shareholders' equity plus the additional retained earnings from the previous year. The examiner extended that explanation there, or that advisory. And even if that was not added or given there by the examiner, of course, that is the reality. The total shareholders' equity. Remember the statement of changes in equity when we were doing published accounts. You bring forward any retained earnings from the previous period, then you add the current year's retained earnings after paying your dividends. Then that is what you carry forward to the statement of changes in equity, where we talk about shareholders' equity. It is the same thing. That is the concept the examiner is saying there in words, but nothing much. It's the same story, or the information we already have. Assumption 9, we are told Weber Distributors Limited has 4 million shares outstanding. So that is the shareholding capacity of this company. Number 10, required rate of return or equity is 15%. Where are we going to use that? We are yet to see. Number 11, the value of the company at the end of year 5 is expected to be 10 times its earnings. All right, required, we are told to calculate the current value per share of this company.